Your bookkeeping reports are basically lab results. They are full of numbers, and somewhere in there is a diagnosis. The problem is that most practice owners don't know which numbers to look at. So today I'm going to give you the 4 numbers that matter most, and these are the ones that are going to show you exactly where to look if something's off. I'm Chelsea Zania, and I am a CPA, and I work specifically with medspa, HRT, and other cash-based wellness practice owners to build the financial systems they need to run a profitable practice and make decisions based on real data and not just guesswork. In this episode, I'm walking you through the 4 numbers that I look at with every single client and exactly what they're telling you. Think of these 4 numbers like the vital signs of your practice. You don't need to look at every single number available to you. You need to know the ones that are the key indicators that there might be something off somewhere. The first number I want you to look at is sales. And this one you're probably already looking at, but I'm going to tell you how to look at it in a way that's productive for you. Okay, so first thing is I want you to set a target because so many of you don't set targets and goals for yourselves. So I want you to have that sales goal. You have a target because you can't hit a target you never set for yourself. The second thing I want you to look at is year-to-date sales this year compared to year-to-date sales last year. So last month, I was looking at sales with a client and she was really disappointed because she'd missed her goal. So she already knew that and she was upset about it. But then when we pulled the numbers and we looked at her sales numbers for year-to-date this year compared to year-to-date last year, she was ecstatic because she'd actually grown 30% in sales year over year. And she's only 2 years into her practice. It's an HRT clinic. So that's a big jump. Sometimes even if you don't hit your goals, when you make that comparison of year-to-date versus year-to-date, you still see this huge improvement and that gives you some real motivation. So I actually want you checking your sales number on a weekly basis and not waiting until the end of the month when it's already happened and there's nothing you can do about it at this point. So sales is one of those that I want you checking weekly, but at the end of the month, that's when you can pull that year-to-date number for this year compared to year-to-date for last year. And that number is not only going to tell you if you're on track, but it's going to tell you how things are trending. So sales tell you if patients are coming in, but it doesn't tell you if you're actually keeping any of that money. So that's what we're going to look at next. The next number is gross profit margin. And this is actually an area probably where I spend the most time with clients because it is an area that there's usually room for improvement in. Your gross profit margin tells you how efficiently you're delivering your treatments and services. And so it will be on the face of your profit and loss statement. And there is actually a report in QuickBooks and it's called profit and loss as a percentage of total income. And I recommend that you run that report because it's going to have the numbers that you need it right on the face of the report. Gross profit is simply your top line gross sales revenue less your direct costs or your cost of providing services. It's called cost of goods sold in QuickBooks, okay? So you should see your direct labor there. So any provider labor should be in that bucket. And then you should also see any pharmaceuticals, any consumables, any supplies that are also used to provide treatments or services there. And then margin just means percentage. So we want to see that as a percentage of sales. So if your gross profit is like, let's say 60 out of $100, 60, we want to see 60% there. So that's why I like pulling that specific QuickBooks report because it already has the percentage for you and you don't have to do any calculations on your own, which is what we want to avoid. Now, with that, I just gave away what I want that number to be. That number should be 60% or higher. Okay, so I took on a new client and when we were looking at her reports, her gross profit margin was at 48%. So we really needed to dig into that, right? Because I want that to be at 60% or higher so that you have enough money left over to cover your overhead expenses and still leave you a nice profit. So this is an aesthetic practice and they have both your injectable services and an esthetician. So she has an esthetician working for her and then she does the injectables. And we were looking at what was going on and digging into this and seeing that that gross margin was lower allowed us to dig in and look harder. And we found that the problem was the utilization of her esthetician. So her esthetician was working for her and she was there during those hours, but she wasn't actually fully booked. And then so that causes this number to be lower than it should be. But that's how you find that problem is by knowing your gross profit is too low in the first place. Every month we want to make sure that we're at least at 60% on that gross profit margin. Now, if when I was describing to you what gross profit should be composed of and what should be included in cost of goods sold, that doesn't look like your profit and loss statement, then you're going to want to grab the bookkeeping cheat sheet that I built specifically for med spa, HRT, and other wellness practices because I set the chart of accounts up to be exactly how you actually do business, okay? So whether you're doing your own books or somebody else is doing them for you, go out and grab that cheat sheet, and that will help you get everything categorized where it's supposed to be so that the numbers are actually useful for you. But stay with me, because gross margin doesn't tell you the full story. The next number I'm going to share with you is going to tell you where the rest of this is hiding. You can have a healthy profit margin and still not be profitable, and here's why. It's because there are two components to profit. We have gross profit margin, and then we have net profit margin. Net profit margin is the very bottom line of your profit and loss statement, and that's going to tell you your profit after everything is taken out. So not just your direct cost of providing services, but all of your fixed or overhead costs as well. Okay, so I have a client, and we'll call her Client K. She's still a client, but when she first came to me and we were analyzing her financial statements, what we saw was that her gross profit margin was always right where it needed to be. That looked great, but her net profit margin was too low. So that allowed us to then dig in and see, okay, well, where in her fixed costs or her overhead costs are the expenses too high? And I could see right away that her rent was too high. And this was both an aesthetics and wellness practice. So it was a full med spa, full menu of services, and it was the main provider who owned the practice. And then she also has another provider working for her. So they had moved to a larger location, but they had done that before they were ready. So then their rent expense was too high for the amount of revenues they were generating. So by looking at that net profit and seeing that it's too low, then you know where to dig in and look, and you can uncover those problems. Now, I would really rather you be looking at that before we make that call and move to a larger location. But when you do it after the fact, you at least can then figure out what your new sales target needs to be. What I want your net profit margin to be is somewhere between 15% and 25%. 15% is an okay business, 20% is good, 25% is great. Now, if you are a sole proprietor and your labor doesn't show up on the profit and loss statement, because in that case it will show up on the balance sheet, you're going to want to take those owner's draws and subtract them out of net income, because otherwise your net income is going to be overstated and things are going to look really rosy even when they're not. So we've covered sales, and we've covered the two components of profit, your gross profit margin and your net profit margin. And those numbers tell you how your practice is doing on your profit and loss statement. But there's one more number that will tell you if the money is actually staying in the practice, because you can be profitable on paper and still feel like you never have any cash. And that's not a contradiction. It's the most important number. The last number that I'm going to share with you today is net cash flow. Okay, and this is arguably the most important of the critical four numbers that I'm sharing with you. And you can find this one actually on your cash flow statement. So down there towards the bottom, you will actually see your net cash flow. And that's just the increase, or in some cases, decrease in cash that you have on hand. A lot of practice owners will assume that if their profit is fine, then cash should be fine. But these can be two very different numbers. Net cash flow should just be positive every month. We want your cash balances to be increasing. I've had several clients with this scenario, but I'm going to give you an example of one in particular where we had a profit on the profit and loss statement and everything looked good. She was a direct primary care clinic. Just over a year she'd been in business. She'd started generating a profit. Her profit and loss statement looks good, but she was still having some cash flow issues. When we got to digging into things, we could see that she actually had a loan that she was paying back, and those payments were showing up on the balance sheet instead of the profit and loss statement, which is accurate. The interest portion can show up on the profit and loss statement, but the loan payment should be on the balance sheet. And that was actually causing her net cash flow to be negative even when she was showing a profit on the profit and loss statement. So it's important for you to know that you can have a profit in the profit and loss statement and still be struggling with cash in your bank account balance. When that happens, it's a signal that something's going on your balance sheet that's affecting your cash flow and not showing up on the profit and loss statement. Okay, so sales tells you whether you're on track. Gross profit margin tells you whether you're operating efficiently, and net profit margin tells you if your overhead or your fixed costs are too high, while net cash flow tells you if you're actually keeping money in the practice. These four numbers work together like the vital signs of your practice, and if anyone is off, you know exactly where to jump in. Reading your financial statements doesn't have to be complicated. You just need to be looking at these four numbers together every single month. In the last episode, we talked about why bookkeeping is just the starting point. And these critical four numbers are what makes the bookkeeping actually useful. But here's where most practice owners stop. They hire a bookkeeper, they check it off their list, and they think they're good to go with their finances. In the next episode, I'm breaking down why that assumption is costing them way more than they realize.